sessions. And today's session is on um, moving from a saver to an investor, what that means. And tomorrow's session as well. I don't want to spill the beans, but I hope you guys will join tomorrow's session to get the maximum value we can get from tomorrow's session. But for today, we have Mukhtar. Muhammed is my leader. I've known him for many, many years. And Mukhtar has a lot of experience, almost 15 years of experience doing this thing. And we thought he's one of the best people that can tell us about money, tell us how to get our finances right, and use this opportunity, this special occasion that we're celebrating the Global Money Week, to interact, bring all our concerns and questions that all our questions that have to do with money in terms of investing in the stock market. If you're not interested in the stock market, if there are any other opportunities and alternatives that you can get into. So today that's what we're discussing. Mukhtar would be on the call, would be on the mic rather to do justice to that. And if you have questions, the way we usually do it is to bring up your questions while he's going on with the presentation. If he has time to respond to you while he's doing that, perfect. Otherwise, we usually have about 5, 10, 15, 20 minutes at the end of each session to ask questions, also offer opportunities for people to make contributions. Well, like I said subtly, it's going to be a very interactive session. And what would make it interactive is if you have questions or any concerns or any contribution while Mukhtar is doing this, please bring it up. But I hope we all pay attention and get the maximum value we can get from Mukhtar. I am going to hand over to him now to do what he knows how to do best. And I believe by the end of today, we'll be leaving here with way more than we came with. Thank you very much, Mukki. Over to you.
Thank you very much, Joseph. Thank you very much, S&P Finance Club. Thank you very much for having me, and also to the participants. I'm sure you're going to get value for your time. Just like Joseph mentioned, I typically like my classes to be interactive. You can interrupt me. I really do not mind. However, if I don't answer you, it simply means I want to get to a nice spot then to pause, then to answer you. Otherwise, you can just write your question in the chat box and in the chat area. And when we are done with the class, we can take up the questions. Please permit me to share my screen. I'll just quickly run through a couple of presentation and we can start. I think I am sharing my entire screen. Please confirm you can see me, you can hear me, and you can see my screen.
Yeah, but it's not on slideshow yet.
Okay, yes, that's what I'm trying to do.
Yeah. Yeah, I think that's that. Yeah.
Okay, great.
Okay.
All right. So my job is very, very simple here. It's how can you as an individual move from a saver to an investor? Then we just talking about fundamentals of stock market for long-term wealth creation. There's nothing wrong with saving. There's nothing wrong with investing. Who am I? This is who I am. I'm not going to bore you with who I am. I think at the end of the class, you can have access to the presentation if you do want it. So I'm not going to bore you. I'm just going to go straight to the meat of the issue. What's the difference between saving and what's the difference between investing? Is saving wrong? The answer is no. But there is more you can do. And the reason why I say there's more you can do is that if you want to create wealth, right, saving cannot help you to create wealth. At best, what saving can do is to help you preserve your capital. And with inflation again, right, I don't think that saving is actually helping you to preserve your capital because your capital is losing what we call purchasing power. What that simply means is that if you bought bread 1,000 naira last year, I'm not sure you're buying bread for 1,000 naira again because why? Inflation has happened. The price of bread has gone up. Maybe you're buying bread now, say for 1,200 or 1,500 or even 2,000 naira, depending on the area and the kind of bread that you're buying. So, in simple terms, what's the difference between saving and investing? The goal for saving is primarily for capital preservation. And I just mentioned that in itself, right, is actually limiting or it's limited. And for saving, the risk level is low. Yes, some people say, okay, but I'm putting my money in the bank. There is no risk. There is still risk if you are saving. And what is the risk of saving? Okay, a bank can liquidate, a bank can go bankrupt. Well, thank God we are in Nigeria and they've increased, what's it called? The insured deposits for depositors. Before it used to be 500K, now it's now 5 million. So what that means is that if you have in your savings less than 5 million naira, if the bank folds, the bank goes bankrupt, you will get that money if it is less than 5 million naira. But if it is above 5 million naira, the best you will get is 5 million naira because every other thing is not insured. So a typical case study could be what happened with SVB. SVB is Silicon Valley Bank. So I think for theirs, because it is the US, theirs is 250K, $250,000. So that's the maximum. In Nigeria, it's 5 million naira. So if you have a bank, if you have money with, say, Bank A, I don't want to call any bank name. You have money with Bank A, you have 10 million in Bank A, you have 7 million in Bank B. So total your savings about 17 million. The best you can get if both Bank A and Bank B goes bankrupt is actually 10 million. You'll get 5 million from Bank A, you'll get 5 million from Bank B. So if you have, say, 3 million in Bank A and you have 1 million in Bank B, you get all your money. Why? Because it is within the limit of 5 million. So that's Nigeria as a case study. So what is the other thing concerning saving? Liquidity is high. So what do we mean by liquidity? Liquidity simply means the ease with which you can have access or the ease with which you can convert your investment in quotes to cash, or the ease with which you can get your money back from whatever it is you have put your money in. That's what we refer to as liquidity. So these are not the only major things concerning saving and investing, but I just wanted to highlight the differences between saving and investing and why it's important for you to move from a saving mentality to an investing mentality. So for saving is capital preservation. For investing, now the goal has shifted. We are not talking about capital preservation, we're talking about wealth creation. It is the only way you can create wealth is through savings. Through investing, not savings. Now, because you are investing, right, one of the characteristics of investing is risks. So the risk level for investing is between moderate to high risk. And I'm not going to bother us concerning risks because I know there's a session concerning risks that will most likely have tomorrow. So everything about risks, you would learn about that. Then for investing, the liquidity varies as well. Why? It depends on the kind of investment that you're investing in. Some investments are not as liquid as some other investments. So that's why, so these are the major differences between saving and investing. All right. I'll tell you exactly how it is. There are only three investment
Eh,
vehicles
eh,
you can
Excuse me, Muki.
participate in. Yes, please go ahead.
Yeah, I think because you're displaying your screen, you can barely see who raised their hand. So I just raised my hand to
Okay,
ask
I didn't
you
see that.
yes, yes. I'll be monitoring that anyway.
I appreciate
Just
that.
to in a very layman term, what liquidity means and how is one of the key differences between savings and investing, like in a in a way that we actually save and invest can understand what you're talking about.
Okay, so in a layman's term, right, liquidity simply means ease at which you can get access to your money. So if you put, say, 10 million naira somewhere, how easy it is, how easy is it for you to get your 10 million naira? So, for example, if you put 10 million naira in the bank, it's very easy. You can get your money back in seconds. All you just need to do is go to a bank and withdraw your money, or you can even transfer that money to, say, somebody. So, liquidity is high, it's extremely high. But now, let's say you put that 10 million naira in real estate. How will you get the 10 million naira? It will take a while. You either have to sell that property, and before you sell that property, you need to find a buyer. Some properties can be in the market for, say, months. It can be in the market for even years. So it varies. So let's say you also put that money, say, in a mutual fund, right? Well, you cannot get your money like immediately. You can get your money in hours or in days. So that's what we mean by the liquidity varies when it comes to investing. So if you put your money in the stock market, for example, you can't get your money immediately. In Nigeria, it is T+2. So even if you are able to sell the stocks, right, you can't get your money immediately. Once you sell the stock, you have to wait 2 days for it to settle, for the whole settlement and transfer to happen. You get your cash and the shares is transferred to the person that bought it. So that's what I mean by liquidity. So liquidity is the ease with which you can get your money back in whatever it is you put your money. I hope that explains it in a very layman's terms.
Yes, yes. Thank you.
All right. But professionally, the liquidity simply means the what is it called? The ease with which you can convert your assets to cash. That's what liquidity means. Literally, as in, that's what it means if you are going to use the proper terminology. But because we want to explain it to everybody, it's more like a foundation class. So we can just take it as that, the ease with which you can get your money back as liquidity. All right, moving on. I was saying that there are only 3 investment vehicles for you to create wealth. I know what it is you are going to say, but there are other kinds of investment. Yes. But when it comes to wealth creation, there are only 3 investment vehicles that would create wealth for you. And these investment vehicles has to do with what we call ownership. For you to be wealthy, you need to own. For you to be wealthy, you need to have a stake. You need to have ownership. And what are these 3 investment vehicles? Yes, you are seeing them. Number 1 is real estate. Number 2 is business ownership. When I'm talking about business, I'm not talking that your small side hustle that you are doing. That's not business. That's you being self-employed. Business simply means that you are employing people. Yes, I know that your small side hustle, you're also employing people. That's not what I mean. Business simply means that you are exchanging resources to give you money. So what are those resources that you're exchanging? Those resources could be human resources. Those resources could be technological resources. Those resources could be systems and structures that you have put in place to generate money. So in order for you to be wealthy, the only kind of investment that you should be looking at to create wealth should be number 1, real estate. Number 2, owning a big business. Number 3, stock market, owning stocks, owning shares. Okay. So I'm not going to talk about real estate. I'm not going to talk about business. What we're talking about today, we'll be sticking to the topic, stock market. We'll talk about the fundamentals, how you can get in and all that. We've already established the fact that you need to move from saving to investing, if not for anything, because you want to create wealth. Okay, why do you want to create wealth? If you don't want to create wealth for yourself, at least leave a legacy, create wealth, give leverage to the people that are going to come after you, your loved ones, your children, your charity, whatever. So it's not just about you. Wealth creation is for legacy. All right, so let me just ask a random question. Do you know any billionaire? The answer is yes. So if I ask you, how is this person wealthy? We say that billionaires are wealthy. So if I ask you, how is this person wealthy? You will point to one or two or all of these things that we are saying here. See that the person is into real estate, or the person has a big business, or the person is in the stock market. Sometimes being in the stock market also means that you are also you own part of a business, part of a big business, or you also own real estate. Let me just give a typical example. The wealthiest man in Africa or the richest man in Africa is Aliko Dangote. What does Aliko Dangote do? Some of you will say, okay, he's not into real estate. Are you sure he's not into real estate? Some people will say he owns businesses. Yes, he owns lots of businesses. Some people say he's involved in the stock market. Yes, his companies are traded in the stock market and he owns majority of those shares in the stock market. So we can identify expressly that he's into stocks. We can identify expressly that he's into business ownerships. He owns lots and lots of business. But we cannot really see that he's into real estate. But I can tell you that he's into real estate. So a typical example, the land where his refinery sits belongs to him. That is real estate. Okay, this is me just digressing, but I'm sure you understand what it means by when I say that the investment vehicles for wealth creation is or are real estate, business ownership, and stock market. Any wealthy person or any billionaire you know, it's either in one, two, or all of these. So I said I'm not talking about business ownership. I'm not talking about real estate. Our focus here is from savers to investing. So why should you invest? What are the benefits of me investing in stocks? There are basically three
Yeah,
benefits for you
Mukki.
investing in stocks. Yes, please go ahead.
Mukki, yeah, we've got a question in the chat box. But I think I'll just ask mine, then also bring that one up there, similar.
All right.
So to not risk offending people like me and a few others that are into porn that are into Ponzi scheme. It's Paul, don't you think you can build wealth with Ponzi schemes? I was just trying to be funny. But I'm also thinking about agriculture, right? And
Yeah.
so Chukwuebuka Ozonya mentioned something like hoteliers. So the list you've mentioned now, are they absolute or the other ventures like let's say you're into agriculture? Well, it may fall under business. I'm thinking it may fall under
That's
one of
that's
the
that's
business
that's what
ones.
I was going to say. So every other thing are derivatives of those
Yeah,
three
yeah,
things I've mentioned. So, for example,
yeah,
your agriculture does not only fall under businesses. Your agriculture is also real estate. You need the land to be able to do the agriculture.
yeah,
You get
yeah,
so agriculture still falls under real estate. Agriculture still falls under business. If you're going to do it very well, and if it's you really want to build wealth from it, it will be large scale or what do they call it? Mechanized farming. That's the
yeah,
agriculture you will be into. And if you are doing that, that is a business. So you're going to set up a business. And it's not a small
yeah,
business, it's a big business. And also, if the business is doing very well, what will happen? You will list the business in the stock market. So you can see that irrespective of how you want to put it, there are only three ways to create wealth. So whether you're using the route of agriculture or you are using the route of, say, a technology startup, it is still the same thing at the end of the day.
yeah,
So even the guys, so let me digress a bit. Even the guys that typically blow, like they developed something, when they develop it, right, they make it a business. And when they make it a business, at the end of the day, even if VCs come in, they raise money, venture capitals, that's what I mean by VC. Even when they come in and support their business, at the end of the day, those VCs will need to exit. And how do they exit? Typically in the stock market. So you still see that at the end of the day, right? These three areas is where most people that creates wealth actually creates wealth. Then to answer the other question, what about a Ponzi scheme? So this is it, right? Some persons have made money through Ponzi. Quite all right. However, because Ponzi is illegal, right? If you are caught, you will face jail term and or fine. So you could either be fined or you would face jail term. What's it called? A good name is better than any amount of money. So integrity is also important. So I hope I answered the question. Or is there any more question?
No, no, no. I think you did. Yeah.
All
Well,
right.
we'll have to. I think there are a few comments about leaving all the questions to the end so you can flow. So we'll leave all other questions to the end.
Oh, okay.
Thank you.
All right. Pleasure. So now we now understand that investing is better. It is only true. It is true investing. Investing is one of the ways in which you can create wealth. We already know what it is you can invest in. So now I want to focus, I want to zone in on just the stock market. So what are the benefits of investing in the stock market? I said there are basically three benefits of investing in the stock market. Number one is capital gain. Well, there are three or four. I typically stick with three, but because I want to explain everything to us, I'm saying there are four. Number one is capital gain. What is capital gain? Capital gain simply means that you bought something 1 naira today, tomorrow it becomes 2 naira, and you sell it. What have you done? You have gotten 100% return on investment. Or say you bought it 1 naira today, and it becomes 500 naira. Sorry, bought it 100 naira today and it becomes 500 naira, say next year. You've gotten like 400% return on investment. So that's what we mean by capital gain. When you have an increase in the share price. So you bought a share at a low price and it becomes a high price the following when you want to sell it. So that's one, capital gain. Then there is two, what we call dividend. Dividend is simply a share of the profit. When you invest in stock, you are an owner. You own part of the business. So the business can be profitable. And if the business is profitable, they can say, okay, we are going to share part of the profit to our owners. So if you work in a company and the company is a public company, right, you should have a stake in that company. You should not just be an employee. You should be an owner of the company. And how do you become an owner? You buy stocks in that company. And if they are sharing profits, you'll be, I typically joke and say you have two-factor authenticator in that company, meaning you're collecting salary and you also be collecting dividend if the company is a dividend-paying company. And let's come back to from savers to investing. So dividend simply means that you as an investor, you get a share of the profit depending on how many units you own in that company. So they can say that they are declaring a dividend of, say, 2 naira. 2 naira might look small. It doesn't look plenty. Now, if you own only 1,000 units of shares in that company and they are declaring dividend of 2 naira, what you have gotten from that company is 2,000 naira. And let's see, you own millions of shares in that company. Let's say you own 25 million units of shares and the company is declaring dividend of, say, 2 naira. What do you think you have gotten? You have gotten free money in quotes of 50 million naira. You did not do anything. You only invested. All right. Then there's another benefit, which is bonus shares. So the company can be doing one say, okay, this year, let's reward our owners. Let's give them extra shares or let's give them bonus shares. You don't pay anything for it. And they're going to do it in proportion to the number of shares you own. So they could say that we'll give you one for two. Now that person that owns, say, 25 million shares. If I do 25 divided by 2, that should give me 12.5. So the person will get additional 12.5 million units free of charge. It happens in some companies. So these are the major benefits of investing in stocks. There's another benefit which we call right offer. This is typically you get additional shares. There's a clause. These shares are usually at a discount to the market price. It is not necessarily that it is always at a discount to the market price. Some companies can say that the market price is undervalued, and they'll come and say that, okay, we are giving right offer at the price we believe this is what the price is for the company. So you don't necessarily need to take up your right. You can just not take up your right. You can take up your right if you want. But if it is at a discount to the market price, so let's say, for example, usually, let's say if the company's share price is 20 naira, they can say, okay, I want to offer right, so, and this right is going to be 15 naira. Simply means that everybody that owns shares in that company, instead of you to go to the stock market and buy at 20 naira, you can just take up your right and pay only 15 naira for it, and you get additional. But now, these rights are only for existing shareholders at a particular date called the qualification date. So if you own shares, today is 21st. So if you own shares up until, maybe if they say the qualification date, for example, is 20th. 20th was yesterday, Friday. It simply means that everybody that owns shares in that company as at yesterday qualify for the 142. So you remember that my 25 million, I'm not the person that owns that 25 million, not tax person, is me. That 25 million units that I own in this company, and I've qualified for 142. I will now get additional 12.5 million units because it is 142. In terms of the rights. So it simply means that I can now pay for that 12.5 million units that I qualify for. I'll pay for it at a discount, and it will now be added to my portfolio, but I'll pay for it. The same thing happens for bonus shares. It's also at a qualification date. So you will not just say, okay, because this company is going to give bonus, I'll now go in and buy into the company. You might not qualify for the bonus if you pass the qualification date. So these are the general benefits of investing in stocks. So you could have capital gain, you could have dividends, you could have bonus, you could have rights. All right. So we've explained the benefits. So let's just talk about some very important foundational investment principles. They are basically three. Number one, time value of money. Number two, compounding. Number three, risks and return. I will not touch much on risks and return. I'll speak a bit on compounding and also about time value of money. So when we say time value of money, we made reference to it in passing. You remember that our 1,000 naira that we used to buy bread last year, and that is now not enough for us to buy bread this year. If we had invested that 1,000 naira, right, that 1,000 naira would have given us interest. Yeah. So maybe it had given us interest of, say, 20%. So we'll now have 1,200 naira this year. So you can see that the money, $1 today, if invested, is worth more than $1 tomorrow. The emphasis and the condition is if invested. So if you invest $1 today, that $1 can become $2 tomorrow or next year. So that's what we mean by time value of money. Instead of you to give me, if we are to say, give me $100 today, or give me $100 month end, I would choose, if I have the opportunity to collect the money, I will collect the money today. Why? Because I can invest it and it can give me what? Returns. So that's what we mean by time value of money, that the money you have today is better than the same value that you will have tomorrow, especially because you have the opportunity to invest that money to get returns on investment. So that's one principle. Now, Riding on the back of time value of money is what we call compounding. So what does compounding simply means? It simply means that instead of you to just invest today, right, and take up that money that you have invested and return on investment and you stop at that. No, what you should do is that if you invested, say, 100 naira today, and it's supposed to give you 20%, so you have 120 naira in 1 year's time. So once you collect that 120, once you collect that money, so you even the interest, you put it back into that investment. So what's now happening is that that investment begins to compound, and within a certain period of time, right, you'll find out that. So typically, there's a rule of, when it comes to compounding, there's something we call a rule of seven. It's an approximate. So there's something called a rule of seven. So what the rule of seven says is that how long will it take for your investment at a particular rate of return for it to double? So we used a rate of 20%. So if I do 20 divided by 7, that should be 20 divided by 7 should give me about 3, right? Nobody is helping me. That's fine. 20 divided by 7 is 2.8. I've used my calculator, 2.8. I just did 21 and said it's 3. So let's approximate it to 3. So what that means is that in 3 years' time, that's my 100 naira will become, that my 100 naira in 3 years' time will become 200 naira. Or that my $100 in 3 years' time will become 200, $200, applying compounding. Now there's something, now this is compound, there's something called continuous compounding, meaning that, okay, you invested simple interest, right, without compounding, simply means that in 3 years' time, I should have 160 naira or $160, depending on the currency I'm using to invest at 20% in 3 years' time. Simple interest is year 1, 20%, take your 20. Year 2, 20%, take your 20. Year 3, 20%, take your 20. So you find out that at the end of 3 years, what you have gotten is 160. But I'm saying that when they give you that 20, you carry that 20, you add it to the 100 that you already have, you invest it in the same thing. So now at year 2, you are not getting 20%. At year 2, you are still getting 20%, but you are not getting the value of 20, because now the principal that you are using to invest has now increased. Instead of 100, you are now having 120. So 120 times 20%. So instead of 20, you'll be getting 24 at year 2. At year 3, so it now becomes, so what you now have is now 144. So you get the math. So you've now found out that as you are investing, your principal is increasing because you're also investing the interest. So that's the principle of compounding. Then I made mention of continuous compounding. It simply means that you don't just put the money once and just leave it. Every year you add to the principal. So it's more like an avalanche. The money is increasing. So I've explained two fundamental or two foundational principles of investing: time value of money, you understand it; compounding, you also understand it. Then risk versus return is a common saying that the higher the risk, the higher the return on investment. That is false. That is not true. Return is never a guarantee. Nobody can guarantee you any return on investment. Even an investment that is considered safe, the return is not guaranteed. Return is always a potential. So the right statement is the higher the risks, the higher the potential return on investment. Because most times some persons will tell you that this return, the risk here is high. So that means that the return is going to be high. The return is always a potential, though. Nobody owns tomorrow. Nobody knows what will happen tomorrow. So return, or rather investment, is synonymous to risks. Again, something I would say is this: anybody that tells you that this investment has zero risks, it's already a red flag, because there is no such thing as a risk-free investment. None. Even what we call risk-free investments in the financial services sector, that's the government bonds, that's what we call risk-free investments, or treasury bills, we call them risk-free investments. Government can fail. A typical example now, just let's, I sympathize with what's happening globally. However, if a country is in a war, right, do you think that the government is interested in people that owns the bonds? Are they going to pay them coupon or interest or treasury bills? The government is interested in, let us first of all be a nation. At least let us solve this war issue first before they will not even think of all the investors. So even what we call risk-free investment in quotes is not risk-free. So again, the foundational investment principles are time value of money. Understand that the best time to invest was yesterday. The next best time to invest is today. Why? Because of the principle of time value of money. And number two, also because of compounding. And now you also understand that every investment has risks associated with it. I made mention of three investment vehicles to create wealth: real estate. Real estate has risks associated with it. If you're in if you're in Nigeria, and particularly in Lagos, there's one major risk, Omonile. I hope I pronounce it well. I'm not Yoruba, so please forgive me. So there's that risk of Omonile. There's also the risk of getting genuine papers and the likes. Now, this is just like the basic. I've not even talked about the major risk, which is liquidity risk. Then if you're owning a business, there are lots and lots of risks. Then even in investing, there are risks, but by the time we are done with this class, you'll be able to come in informed. You would have been able to know how to mitigate some of these risks. Now, this is what I want us to focus on, and we'll be done and we can now take questions and answer everybody. Before you invest in any company, before you buy stocks in any companies, there are certain fundamentals you must understand. There are not plenty, it's just 5. If you miss these 5 fundamentals, you are investing blindly. You are just following the crowd, you are just following the hype. So what are these fundamentals? Number 1, you must understand the economic goal and the economic cycle you are in. For example, we know, or I know, that Nigeria's economic goal is to increase the economy to a $1 trillion economy. What does that mean? In simple terms, it simply means to move our GDP from whatever it is today to a $1 trillion. Our GDP is about, let's say, for lack of good statistics, is about $300 billion. So now to move it from $300 billion to $1 trillion simply means that the economy needs to grow times 3. Yes, you are correct. It is 3.3333. Let's be conservative. Let's say times 3. So what we have just said is that from 300 billion to 1 trillion, the economy needs to move times 3. Now we understand the economic goal. And the reason why you want to understand the economic goal is that you will now begin to understand why the policies the government is putting, those policies. There are basically 2 economic policies. Number 1 is the monetary policy, and number 2 is the fiscal policies. So these are the policies that drive the economy in the direction the government wants the economy to go. And that now moves us to the next bit, which is the economic cycle. What is the economic cycle? There are basically 5 phases or 5 areas of the economic cycle. Please just imagine with me, we are drawing a circle, and at the apex of the circle is what we call boom. The economy is doing very well. And at the bottom of the circle, or what we call the trough, is recession. So we have boom up and we have recession down. Between boom and recession, the economy has to decelerate, it has to slow down. So we move from boom to deceleration, from deceleration, then you go to recession. From recession, you move to recovery. Then from recovery, you move to acceleration. And from acceleration, you go back to boom. So I've mentioned 5 phases or the 5 cycle of the economy. So you have boom, you have deceleration, recession, recovery, acceleration, like that. And how do the government move the economy from one phase to another? Yes, the government can move the economy from boom to recession. It is possible. How? Through its use of economic policies. What are these policies? Monetary policy. What's the other policy? Fiscal policy. What is monetary policy? In simple terms, monetary policy has to, in simple terms, has to do with the money supply in the economy. And how do the government control the money supply in the economy? It is through 2 means. Number 1, interest rates, either increasing interest rates or reducing the interest rates. Number 2 is printing of money. Yes, you heard me correctly. The government can print money if it wants. So this is how the government, and what's it called, controls the money supply in the economy through the monetary policy. Or the government can say that instead of printing money, the government can say that this money, there's too much money in the economy. Let us take the money from the economy. A typical case scenario, not to relieve bad experiences. There was a time when they said that your naira was not a legal tender again, that you needed to submit your naira back to the bank and they gave you a new naira. That's a policy. All right, so I've explained monetary policy. Then the other bit is fiscal policy. So what does fiscal policy do? Fiscal policy, in simple terms, right, is how the government creates money for its expenditures. So it has to do with government spending and it has to do with taxation. So the government can increase taxes, so it therefore has more money for its expenses or for its expenditure. Or the government can reduce taxes and thereby there's a lot of money in the economy. So I already explained to you number 1. So you need to understand the economic goal and the economic cycle. Somebody will not be asking me. Before you ask, let me just answer. Why is this important? What I want to do is to invest in stocks. That's all I want to do. Why do I need to bother myself to learn about the economic goal and the economic cycle? Let's move to the next bit. Because when you understand the economic goal and the economic cycle, especially the economic cycle, you will know if you should even invest in the stock market or not. Because the best time for you to invest in the stock market is during a recession. Yes, you heard me right. During a recession. Okay, someone will say, okay, but Mukki, during a recession, prices are falling. Everything is going down during a recession. Yes, everything is going down during a recession. That's the reason why you should be investing in a recession, because the prices are already low. So it is the best time for you to buy. If you buy during a boom or you invest during a boom, you are buying at a high price. Remember the benefits of stock market. One of it is capital. One of it is capital gain, meaning that your share price is supposed to increase. But if you are buying at a boom, the share price is already high. What do you think will happen? It will decelerate. The share price will start coming down. So let me answer another question that someone might want to ask. So this is part of the reasons why some persons' hands were burnt during the 2008 market crash. Well, in Nigeria it was 2008, 2009, but globally it was 2008. Because why? They were buying when the whole thing was, everything was inflated. The prices were already high. The economy everywhere was doing very, very well. The next thing is for it to now start coming down. So once you understand the economic cycle, you know that you want to buy during a recession, that's the best time to buy. Okay, you can say, okay, how will I know when it's a recession? If you don't know when it's a recession, at least you will know when the economy is recovering. That's also another time for you to buy. Okay, if I don't buy during the boom, I don't buy during recovery, when should I now buy? You can buy during acceleration, when the market is accelerating. And you want to exit when the market is booming. Yes, you heard me well. You want to exit when the market is booming, except you have other kinds of investment goals. So we'll talk about that as well. So understanding the economic goal and the economic cycle lets you know that, okay, this is right time for me to come into this market, or this is right time for me to invest. Now, the next thing is what sector? So, okay, now I know, let's say we are in a recession or we are recovering. Well, for Nigeria, we are between recovering and accelerating. If I say accelerating, people say, Mukki, you are just being too optimistic. But that's what statistics says. We are not in a recession. We are either recovering or accelerating. I can tell you we are accelerating. So that means now that we are accelerating, so Mukki, where should I now invest in? Very simple. What sectors should I invest in? It's as simple as ABC. Invest in sectors that the government has interest in. Yes, you heard me correctly. Invest in the sectors that the government has interest in. The most important player in any economy is the government. The government has the most money. In fact, the government has too much money that the government can even create money out of thin air. They can print money. They can borrow money. They can increase taxes. So the government has money. So which sector is the government interested in? So in Nigeria, between 2024 till now, the major area that the government has been interested in is the financial sector. Why? Simple, because the government has a goal, has an economic goal, increase our GDP from what it is to $1 trillion. The only way you can do that is if your financial sector is strong. So that's the reason why you see all this recapitalization exercise happening. Started with the banks, moved to the insurance companies, and now it's now with the capital market companies. Once these financial services sectors are solid, then the government can easily achieve its goal. So that's the reason why the financial services are a sector of interest for you if you're a smart investor. So what other sectors of interest should you focus on? Well, oil and gas. We all know why. It's a no-brainer. I don't know how much fuel is in your area, but for those of us in Lagos, I think we're actually still enjoying because we're having like 1,300 naira or 1,400 naira as at today, the 21st of March 2026, in case you are watching the recording. Having said that, some other persons are finding it difficult. For us, it is even better because to an extent, we are not importing solely. We already have a functioning, working refinery thanks to you know who. So if that was not available, I'm sure maybe by now we'll be saying that fuel is 2,000 naira or even more than 2,000 naira per liter in Nigeria. Now, the war is not happening in Nigeria, it's happening somewhere else, but it's affecting us here in Nigeria. So those are the areas the government is interested in. Oil and gas. What other areas is the government interested in? Let's see. Power. Yes, government is interested in power. What other areas? Government is interested in agriculture. Okay, I have tried. I've given like four areas, so you can get the rest yourself. So you understand the reason why you're interested in those areas. Because if the government is interested in those areas, the government has so much money, the government can incentivize those companies so that those companies already have leverages. So their profits will be maximized, their share price will increase. If they are a dividend paying company, they'll most likely pay dividend, and what they are paying dividend from is a lot of enough profits to go around. Okay, before you even go to start analyzing companies, you need to have an investment goal. Some persons just invest, they don't even have a goal. Is your goal 20% return on investment? Is your goal 30%? Is your goal 100%? If you don't have a goal, when you achieve the goal, how will you know that that goal has been achieved? Are you just investing blind because everybody's saying stock market, stock market, stock market, stock market? No, you should have a goal. Once you have a goal, once you this your goal will now define your exit from the market. Basically, there are two ways in which you should exit the market. Number one, your investment goal has been achieved. Or number two, the economic cycle has changed. It has moved from a boom to deceleration, or it's once it's moved from boom to deceleration, exit the market. You mustn't wait until it gets to recession. I jokingly say this, right? This is what I jokingly say. When the market is greedy, you should be fearful as an investor. And when the market is fearful, you should be greedy as an investor. When is the market fearful? During a recession, during a recovery. When is the market greedy? During a boom. So you are exiting during a boom, you are entering during a recession. So these are one of the ways in which you can exit, or the other way is your investment goal has been achieved. So either your investment goal has been achieved or the economic cycle has changed. So we've explained three fundamentals before you invest in any company. Now, you now analyze the companies in the sector. And how do you analyze the companies in the sector? Now, you already know the companies that you are going for. You already know the sectors. What are the sectors again? Those sectors that the government has interest in. So you will now go and check, okay, how many companies are there? So if A PLC is there, B PLC is there, C PLC is there, Mukki PLC is there, Joseph PLC is there, you will not say because you like Mukki, you are going to invest in Mukki PLC. Or you will not say because you like Joseph, you are going to invest in Joseph PLC. No sentiments. You already have a goal, an investment goal. If Mukki PLC is not doing well, don't invest in Mukki PLC. If Joseph PLC is not doing well, don't invest in Joseph PLC. If you check all the companies and it's only one in that sector that is doing well, once you have done your analysis, fundamental and technical, all you need to do is what? You need to focus on that company. So it is that company. Now move to the fifth fundamentals. You now invest in the companies that meet your goal. So you can say that maybe your goal is you want to be receiving income. That's dividends. So if A does not meet that criteria, A is not the company you should be investing in. If B is the company that meets that criteria, then B should be the company you should be investing in. Some companies are income companies, meaning they pay dividends. Some companies are growth companies, meaning they have potentials to grow. And some companies give you both. They are both income companies, they pay dividends, and they're also both growth companies. So depending on what your investment goal is. So that's okay. If A does not meet it, does B meet it? If you check the entire sector and none meets it, you're not investing in that sector. You move to the next sector. Remember, the government is interested in multiple sectors at a time. You go ahead into that sector, you find a good company in that sector. So it has helped you to narrow down the hundreds of companies to invest in. Or if you're not investing in Nigeria, investing in the US, it is the same thing. It has helped you to narrow down the thousands of companies. So you now know that, okay, these are the areas I'm interested in. So let me just digress a bit because we don't have that in Nigeria. So let me go to the US. So what everybody is talking about, what everybody needs, whether it is the government or not, especially the US government. The US government is interested in everything artificial intelligence. If you've been following the news and all that, so they had a what's it called? An agreement, a partnership with one of those AI companies, and all of a sudden they had a U-turn, a 180 degrees. That's a U-turn, 180 degrees, and they are now in bed with another AI company. What does that tell you? Government is interested in what? In AI companies. So what do? What are all the companies associated with AI? Not necessarily AI, associated with AI, because there's also a ripple effect. Those are the companies you want to focus on. So that's your sector of interest. You very much your investment goal. So by the time you analyze that sector, what is the one, two, or three good companies in that sector? You invest in those sectors. So after analysis, so invest in the companies that meet your investment goal. So basically, this is how you go about investing in the stock market. All right, because we are Nigerians, let's bring it home. You've done everything. So what do you now do? Step one, get a licensed broker. The reason why I said get a licensed broker, what do I mean by licensed broker? The person is licensed and registered, or licensed or registered with the Securities and Exchange Commission, and also with the Nigerian Exchange, formerly Nigerian Stock Exchange, now Nigerian Exchange. If they cannot tell you, you cannot see it, how do you know? Please just go to the SEC website and check that this person is a capital market operator, that you are investing in the capital market. If you are investing in the financial market, go to the CBN. Is this person registered? When I'm talking about person, I mean company. Is this company registered with the CBN or licensed by the CBN to do what it is it wants to do? Is this company licensed by the SEC? CBN is for financial market. For capital markets, that's where we talk about stocks. It is the SEC and the Nigerian Exchange, formerly the Nigerian Stock Exchange. Check. You go to their website and you check. Even if, now listen, even if this company is licensed by the SEC, you go and check, is this firm or is this broker or is this dealing member firm or is this trading license holder active in the Nigerian Exchange? If the answer is no, please find another broker, find another company to trade with. There are over 200 companies you can choose from. So but make sure that the one you are choosing is one that is all right, that is correct. So once you have done that, then the next thing is to open a trading account with them. Then you now fund your accounts. They typically have a wallet, you fund your accounts. Then you now go ahead and select the stocks. You know how to select the stocks. We've already explained it to you. Then you now execute your trade. Your trade will now settle. Once your trade has settled, you now begin to monitor and manage your portfolio. The reason why I said you must monitor and manage your portfolio, remember, there are two ways in which you can exit. Once your goal has been met, or once the economic cycle has turned or has changed, you can now exit the market. So it's as simple as this. In closing, building wealth takes time. Yes, it takes time. What you need to do is you need to be investing regularly and take advantage of compound interest. We already understand this. I didn't mention this in passing and also in detail. I explained it. So take advantage of compound interest. Number two, your investments, right? Your investments is for wealth building or wealth creation. If it is income you are looking for, right? Develop yourself so that you can increase your income through your career, or just go and find additional income streams. You can become a creative doer. You can sell something. Just increase your income. Your investment is supposed to be for a long term. So that brings us to the third point. Set clear financial goals and work towards them steadily, consistently. Wealth building takes time. The stock market is not a get-rich-quick scheme. To build wealth takes time. There's what we call short-term investing, medium-term investing, long-term investing. If you're talking about wealth creation, that one falls under long-term investing. It was said that It's not it was said, it's what it is. We all know the most successful investor, that is Warren Buffett. He's a billionaire in dollars. Warren Buffett made over 80% of his what's it called, of his wealth after the age of 60. You heard me right. After the age of 60 years. Why? Because he applied the principle of compounding. He has been investing a very, very long time. So let me conclude so that we can take questions in a couple of minutes we have. In conclusion, invest early, start early, invest often, and stay diversified. So don't put, you already remember how to invest, that sector that you are going into. What are those sectors that the government has interest in? Diversify your investment in those sectors. Then, number two, the best time to invest is today. Or rather, the best time to invest was yesterday. The next best time to invest is today. There's a parable that says that the best time for you to plant a tree was 20 years ago. And the second best time is actually now. So the reason why you're planting a tree 20 years ago is so that you can benefit from the fruits and also from the shade of that tree today. But if you have missed 20 years, what do you now do? You start now. Why are you starting now? Because you will now be planting that tree. You might not benefit from it directly, but indirectly through your children, you have benefited because you'd have built that tree for your children, like giving your children leverage. Thank you very much. You can join my WhatsApp community, or if you want a one-on-one, you can go to my online store and reach out to me. I am going to stop sharing my screen and I am going to take questions if there are any.
Yeah.
Thank you very much.
Thank you very, 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 very much, Mukki. Thank you. From my end, I don't think I'm surprised by the value of this dish out whenever we have sessions that you're anchoring, and I believe that's the case with everybody that has joined today. Thank you very much. We have a couple of questions in the chat box. Well, I would want us to start with those that have their hands up so they can ask questions. Then, when you're
All
done
right.
exhausting those ones, we can go to the chat box. So I think the first person on my list is Jane. Jane Uzo. Yeah, please, you have the floor. Go on.
Okay, so I can go ahead now. Good evening.
Good
Yes, you
evening, Jane.
can.
Please go ahead.
Okay, good evening, everybody. Well, this was a very interesting presentation. Okay, my question is, can one invest, if someone is a business owner, can someone invest in the name of their business or invest personally? Is there a difference between the two? And is there anyone that is better than the other?
Okay.
Is my question
I'll
understood?
answer. Yes, your question is well
Uh,
understood.
thank you.
It's a very, very good question.
And a
Very,
smart
very
one.
good question. Yeah, it's a very good question. So the reason why I say it's a very good question is because most businesses, right, they don't think in the line of how you are thinking in terms of their business being, in terms of their business investing. So your business itself is an entity. Jane is also an entity. So you, Jane, you are separate from your business. So let me just digress a bit to answer your question. Most businesses fail because they don't invest. That's one of the reasons why most businesses fail. Most businesses fail because they don't invest either in the business itself or in something else. So having said that, right, it is okay for your business to invest in itself and also to diversify and invest in other things. And also for Jane herself to also invest as a separate entity from the business. So your business is supposed to have goals. And if your business does not have So what investment does is that investment helps you to create wealth. Already established that fact. So if your business is investing as a business, your business is doing what? Your business is creating wealth. If there are opportunities in that area or in that sector or in that niche where your business is operating in, your business can easily jump at it. Your business can easily take advantage of it. So it's not a case where technology now comes up and technology now makes your business redundant. You would already be abreast and ready to take advantage of whatever technological advantage that is available in your business's sector. So yes, your business must invest as a business, not just necessarily investing in itself, can also invest as a business having an investment account. Then as Jane, you are also separate from your business, remember, so you should also invest. So the answer is both of them must be, as in both of you should invest. So Jane invests, business also invest. So if you find out, so let me still digress a bit. One of the most successful companies in the world is Amazon. How did they get here? Very simple. Amazon invests a lot in what we call R&D, research and development. So they don't just carry all their profits and give it to shareholders. They take part of the profit and they invest part of those profits. They also invest it in other businesses. So let me also digress a bit. I hope you know that Apple has shares in Samsung, just as Samsung also has shares in Apple. Now, these are businesses. You can go and verify. So I believe I've answered your question. Next, please.
Okay,
Thank you.
thank you, Mukki.
You're
Thank you,
welcome,
Jane,
Jay.
for your question. The next on my list is Uchechi. Uchechi, you have the floor,
Okay,
and
all right.
thank you for joining.
Uh, Thank you. Thank you, Muki. I think I wrote down so many questions, and during the course of the presentation, most of
I
them
answered
were
them.
answered. Yes, thank you. So, but
Okay.
one final one that I have. So looking back at your own journey, what is something you used to believe about long-term investing that you've now changed your mind about?
Okay.
I hope I didn't put you on a hot spot there.
You actually did. You put me on a hotspot. Should I answer? Should I not answer? Joseph, is it every question I'm supposed to answer? Eh?
Yes, my leader, all of them.
All of the questions.
Yeah,
Interesting.
that's
All right. So
why we're here.
what I used to what I used to believe about investing initially, right? I used to think that investing is something that should be quick, right? It should be very, very fast. If I'm doing it, let me get the results immediately. But after a while, I found out that investing takes time. It's a journey, it's a process, and sometimes that process is painful because you will lose. And when you lose, right, your losing should encourage you to continue. Let me digress and say it this way. For you to be, most of us here, and in thousands of naira. You are a thousandaire because you have lost 1,000 naira or you have lost thousands. In order for you to move to the realm of millions, you must have lost millions. Some persons might not understand what it is I'm saying. Don't worry. But life would help you to understand it. So you see all those people you call billionaires, right? I'm not exaggerating. They have lost in billions. Some persons might now say, okay, well, can I have the capacity to lose billions of naira? I don't know about you. But if you want to be a billionaire, you would have spent in billions or you would have lost in billions. For you to be a millionaire, you must have spent in millions. Okay, oh, sorry. You must have spent in millions or you have lost in millions. Go and check it out. People in businesses that their businesses are doing well, their businesses did not start doing well all of a sudden. They learned their lessons. Lessons were learned. They did not give up. They continued. They persisted, and they've learned. Let me digress a bit. An inventor, Thomas Edison, invented the light bulb. And they said that he invented the light bulb after 1,000 trials. And someone asked him and said, okay, why did you continue even after you have failed? And his response was that he learned 999 ways of how not to make a light bulb, or of how you do a light bulb and it won't work. So on the 1,000th time, he was able to invent that product or that solution. So why am I saying all this, right? Investment is a journey. It takes time. And because you said the lessons I've learned, because I wanted to, right? I believe that investment should be very fast. So I've actually lost some money because of impatience. But right now, I am very, very patient. I can wait for 20 years. I can wait for 30 years. I'm still a young man. My football age maybe 13, under 13. I can still go and play for Super Eagles. So at 13 plus 30, you should get what I mean. Uchechi, I hope I answered your question.
Yes, you did. Thank you so much.
You're welcome.
Thank you, Mukki. The next person on the list is Smile A. So that's Smile A. That's the name. You have a Smile
Good
A.
evening,
Yeah, good evening.
Good evening, Smile.
Oga Muki. Oga Muki, thank
Yes,
you
sir.
for this lecture. You answered some questions that I've been asking behind all this work, but I have another question. You were talking about the interest of the government. How do I know the interest of the government? Because if I know the interest
It's
of the
very
government, then I should be able to invest in that sector. How do I know the interest? Because if I know the interest of the government, that's when I can analyze the companies
companies related
in that sector.
in that areas, yeah, in that sector.
Yes.
It's
So
very
how do
it's
I
very, very
know?
simple.
How do I know?
Very,
Oh,
very, very simple. Number one, listen to what the government is saying. Our government is very proud. Any government is very proud. They tell you exactly what it is they are doing. Okay, a typical example. We all know what's happening in Nigeria. We know that our government was in UK. What was discussed in that UK? Some MOUs were signed.
Port.
Pardon? Okunu, you want to help us? All right. So
Yeah, go on, please. Yeah.
when our government is doing something, right, it is everywhere. So someone said, "Now they still MOU paying me pass." Okay. Where I'm getting at is that the government, right? The government, they will tell you exactly what it is they are doing. Your own job is to listen, not necessarily as a Nigerian, but as an investor. Whether it is the government you like or the government you don't like, the government is already there. What can you do? You're an investor. You have an investment goal. This government that is now here, how can I benefit? Government, what are you people doing? I go to where I listen to news and I go straight to the business section. I'm not interested in gossip or whether Joseph slap Mukki or Mukki slap Joseph. It will not add anything to me. But you see that government, what is the government saying? What happened? Tinubu traveled to where? Shetima traveled to where? Why did they travel there? What's happening there? They will tell you. I will read everything. I'll take my time. I will read everything. You see that long article? I will read it. The answer is inside there. They discussed something. So a typical example, there was a time when the government went to Brazil, for example. What did they discuss there when they went to Brazil? I'm talking about the Nigerian government, in case you're watching the record. The Nigerian government, now sometimes it's either last year, 2025, or ending 2024. What did they discuss there? Primarily, what was discussed there in Brazil was aviation, airports. That's what was discussed there. Me as a smart investor, what would I do? What was discussed there was aviation. I come to the Nigerian stock market. Which companies under the aviation sector? They are not plenty. Which one is the good company there? There's not even plenty. I put my small money there and I'll just sit there and wait for other people to catch on. So you can go and check. You can just do a bit of back research and check. So aviation sector, check between 2004 and 2024 and today. You find out those companies, they have already benefited. Remember what I told you? If a government is interested in a sector, that sector is incentivized. I don't know how they do it, but those sectors get incentives from the government. And because they get incentives from the government, their profits would be high because they are getting leverage. It's not like getting a grant. I'm not saying they are giving a grant. So how do you get those areas? Follow the government. Government is going to UK. Follow them and go to UK. I don't say go and buy passport to follow them online. Just track what it is they are doing. Forget what every other person is saying. You are an investor, not just a Nigerian. You are also an investor. Follow them and track them. So you begin to know those sectors, those areas. The government, once the government does something, they will tell you. But you now you have to look at it from the lens of an investor. I hope I answered your questions now.
Yes, sir. The last one.
Oh, there are two.
Yes.
Just we should be taking only one question so from each person, and they shouldn't
Yeah,
bundle questions
yeah.
together so
Yeah,
that other
smart.
persons can.
Smart. If it's not a follow-on question on the one you've asked, can I request that we come back to you so we can give other people a chance to ask
Smile, meet
theirs
me in
before
No
we
problem.
camera.
run out of time.
No problem. I know what to do. God
Smile,
bless
meet
you.
me in
I
camera.
appreciate you,
Thank you.
sir.
Yeah,
Okay,
No
thank
welcome.
you.
problem.
So the next on my list is Juliana. Juliana, you have the floor. Thank you.
Okay, good evening, everyone. Thank you
Good
so
evening,
much
Juliana.
for the session. I joined in late, but I'll still catch up later. And the little I learned was quite helpful. Please, I don't know if you've answered the question already, so I'm just asking in doubt. What's your take on managed portfolio on Bamboo app or somebody managing your portfolio? What's your take, especially on the Bamboo app, please? What's your take on that? And then, considering the economy now, you have so many things going. I don't know. You have so many things on your table. It's not just the investment and the stock. There are every other aspect of our life that is going on. So I'm like, what's also? I would want to know your take on getting someone to manage your portfolio in such a way that you have access to it, you're seeing it, and what's your take on it? I would really want to know, please. Thank you.
All right. That's a very good question, Juliana. So I actually encourage managed portfolio. And the reason why I encourage managed portfolio is because with a managed portfolio, I'm not saying give Mukki money to go and buy what's it called, to go and buy stocks for you, or give Joseph money to go and buy stocks for you. That's not what I'm saying. That's not managed portfolio. A managed portfolio is, say, for example, typically, right, somebody will say invest in the S&P index or invest in the all share index. That's more like a managed portfolio, right? So you have a basket of what it is that is being tracked and is being bought for you and that's being managed. So the reason why I encourage managed portfolio is because these guys, right, are professionals. That is their job. That is their work. That is what they do to earn a living. And because of that, these guys are professionals. So they have the best in terms of research and all that. So they will do their best to make sure that you get a positive return. Having said that, it is not for free. It is most likely for a fee. You pay them a fee, what we call management fee. So it is okay to give the professionals to manage your funds, whether it is bamboo, whether I'm calling bamboo because you mentioned bamboo. I don't want to promote any trading license holder or any I don't promote any broker. So long as yes, bamboo, I can tell you bamboo is registered with the SEC and bamboo is registered with the Nigerian exchange as a sub broker to a trading license holder, which I will also not mention. So having said that, right, you can, if you don't, especially when you are starting out, before you begin to learn by yourself, it's okay to use managed portfolio. But you need to understand how managed portfolio works. So if your managed portfolio, a typical example is even mutual funds, for example, is a managed portfolio. So mutual fund is a managed portfolio. There are different aspects of mutual fund. The mutual fund can be in fixed income or the mutual fund can be in equities. If the mutual fund is in fixed income, it simply means that the mutual fund is a money market mutual fund. What they buy is the treasury bills they buy. They buy commercial papers and they buy government bonds. That's what they buy for the money market mutual fund. Now for the equities market mutual fund, what they invest in is they invest in different kinds of equities. That's what the fund invests in. So you have a plethora or different kinds of different kinds of companies in that fund. And what also happens is that investing in a fund helps you to diversify your portfolio, to diversify your investments in quotes. So what that simply means again is that because it is diversified, your risk is spread. However, there's also the downside. There's also the downside to having a what we call managed portfolio. If the portfolio managers don't know what it is they are doing, you will not be maximizing your investments. If they know what they are doing, you will be maximizing your investment. Also, especially when it comes to equities. Now, equities are doing very well. Simply, and I can explain the simple reason for you. Simply because of what it is I said, in the sense that the economy is accelerating, meaning that everything is going towards that goal, economic goal, or towards that boom area. So share prices will be going up, but it is not always like that. A time will come when share prices will come down. And if it is an equities fund, right, your portfolio can be negative. Why will your portfolio be negative? For example, let's say you invested 100 naira in a stock. If you invested 100 naira in a stock, that 100 naira gave you, say, for example, 100 units, meaning you bought each stock at 1 naira. What you have in that stock, now I'm trying to use this to explain, what's it called? A fund that is being managed. So it's 100 naira, 100 units. The share price now goes down. It's now the value now becomes 8 naira. Your units still remains 100. Nothing has happened to your unit. When it comes to stocks, right, gains or losses are only potential. Let me use that word. Let me borrow that word. Gain or losses are potentials. They are not actualized until a sale happens. So if the price moves from 100 to 120, you have not gotten 20%. If the price went from 100 to 80, you have not lost 20%. What you have is still 100 units. So that 100 units is now worth 80 naira. Or that 100 units is now worth 120 naira. The only time you get value in terms of profit or loss is when you sell. So having said this, let me now explain for a diversified portfolio, the downfall. When the market is going down, you still own the same number of units you have, but the value of those units have reduced. So what typically happens is that impatient investors, especially if you've invested in solid companies or the sector you're investing in is a solid sector, like the banking sector, they have an index, or the NGX 30, the 30 most capitalized stocks in the market. Those companies' share price, economy has changed, has turned. So some of those companies, their price will be deep, but you still own that unit of shares. When you sell, what happens? You realize a loss. And when it's going up and you sell, what happens is that you realize a gain. So these are the downfall for investing in a managed portfolio. Howbeit, if you are just starting out, just testing the waters, the best way to invest is to invest in a managed portfolio. I hope I answered your question, Juliana, and I
Yes,
gave you
please. Thank you
context
so
for
much.
it.
Yes, yes.
You're welcome.
Thank you, Mukki, for being very exhaustive with that answer. I think that the last, in terms of the list that I have, is Tuchku. Tuchku, you have the floor. Go on, please. Thank you. Like, if you're speaking,
Yeah, good
you're
day.
muted.
Yeah,
Yeah,
good day.
yeah, good day. We can hear you now.
Good day,
Yeah, I want
Chuchuku.
to
We
ask,
can hear you.
yeah, good day. Yeah, yeah, thanks for the class. It's quite an interesting and useful. I want to ask for a newbie, someone that wants to pay more interest in this aspect. Uh, um, where can the person start from? I know it's a broad question, but um, like
It's
how
a
can
valid question. It's a valid question. So this is what I would say, right? This is what I would say. Um, alone you go fast, right? Alone, oh, you go fast. Together you go far. Even when you are tired, by the time you see your brother moving, like you'll be motivated. So what I said that was not heard is, are you in the S&P community?
no.
I suspected. So the first thing you need to do is to join a community of investors. What that will do for you, right? That's the first thing you need to do. You need to join a community of investors. So a typical example, right? If you have 5 friends that are wise, right? If you have 5 friends that are wise, I don't want to use the other one. If you have 5 friends that are wise, you didn't count well. They are not 5 wise people, they are 6 wise people. Because it's only a matter of time you'll be among the wise men. You'll be counted amongst the wise men. Oh, these people, they are wise people. So the first place to start is to join a community of like minds. So I recommend the S&P Finance Club. Join them. By the time you join them, you begin to see resources. Give yourself time. And when you join a community, the best way for you to grow in that community is for you to be active in that community, participate, ask all the questions, the good ones, the bad questions, the ugly questions, ask them. Don't be ashamed though. You are there to learn. You have a goal. Give yourself time. You find out that all the necessary materials will be there. Somebody will be guiding you. Today you will learn something. Tomorrow you will learn something. The knowledge, just like as investment compounds, the knowledge will compound. Within 3 months, you would see your progress. You will now know exactly what to do. So the best place to start is not even to go and look for is not even to go and look for materials. Forget about materials. Just join a community, observe them, ask questions, learn from the community, and you find out that you begin to grow. Then you now know the right areas to go to. So the starting point, go and join a community. I hope this helps you to Chuko.
Yeah. How can someone access the community?
I think the link will be shared. That's if it's not shared. Okay, the link has been shared, so you can check and you can join the community. I highly
Yeah,
recommend the
no, thank
community.
you.
I've been in the community for over a year, and this is me telling you this. So it has improved my investment knowledge. Forget my years of experience, forget my background and everything. Joining the community has improved my investment journey to the extent that I had to ask my own community to join the S&P community. If it's not good, I will not recommend it.
Hey, thank you very much. Muki just being very modest. But to emphasize on what I think he has said is the community, and what it means is everyone there is there to learn from one another. So you just access the resource in terms of tangible resource, in terms of knowledge, in terms of people. You can ask questions. If you're confused about anything, you can ask questions. If you have anything to share, there was a time I had a lot to share. You look around and you're asking, who do I share this thing with? Who do I discuss investments with? That's the perfect place to do it. So, and Muki also has the securities and investment platform. I'm also there and I'm recommending it. Just like you said, if I'm not getting value from there, I wouldn't recommend. And you will find that link, the last page of the slide, which will make available to everyone that has joined today's session. And Mickey, I think you have that link. Can you also add it to the chat box? So, and to
I'll
to
drop I'll
emphasize
drop
on
it
what he
now.
has said, to emphasize on what he has said, being in a community as a passive member wouldn't really do justice to what I think you would like to gain as a newbie. But it's being active and learning, active learning, if you're starting out on anything, a new skill, a new venture, a new business, you have to open your mind and be willing to fail and be willing to look stupid when you have questions. Questions as simple as what is the stock market? It's expected that you should know that. But such questions are also very important for you to ask. That's where you can start learning. And if you hear technical terms, even though we try every means possible to keep them as layman as possible, if you hear any technical terms or terms that seem to be um, too specialized, you can just take some time, go read, research, and learn about those terms. We have resources, we have the YouTube channel, we have monthly sessions like this, like Mukki usually comes to give sessions of this. We have another one tomorrow that Chimex will be giving. Then again, you can also access individuals, like I've mentioned before. If you have something very personal, you don't think it's okay to share on the group, you can DM me, Muki, you can DM me, and DM anybody on the group chat. Then personal learning, and the second part is actually doing. So I wouldn't recommend you spend a lot of time doing the learning. If you're a thousandaire and you can afford to spare 5,000 naira or 10,000 naira, just spare that money and use it to start doing something. See how the stock market works. Money, not necessarily that you're going to lose it, but use that to start in terms of running a demo portfolio, right? See what 10,000 can do for you, what kind of securities you can buy. You can buy a couple of units, in the Nigerian Stock Exchange, some share prices are below 100, some are even below 10 naira. You can buy a couple of units and just see what it's like trading, buying, selling, seeing what charges are, seeing, reading news. If it's one or two companies you're invested in, you pay attention to all the news coming out from that company. if there's something in the country that you think is related to that industry, it also helps to just put theory into practice, right? So, boy, I wish you all the best, and I believe it's just a matter of time, and you'll be more of an expert like Muki and the rest. So, thank you very much. We have other questions in the chat box. A few of them have been answered already, Muki. Although we don't have much time, we're 12 minutes past the time, but maybe we can use 5 minutes to do justice to those ones. I think Anthony has one of those questions. So, Anthony, I don't know if that's a question you want to ask or something else, but you have the floor, please.
Yeah, I want to ask a different question. Okay, thank you very much for the lecture. I hope you can hear me, sir.
Yeah, I can hear you, and everyone else
Uh,
can hear you, I believe.
all right, all right. So, what I want to ask is, what are the financial and technical matters one will look out for before investing in a company?
Okay, very simply, when we're talking about financial matters, we're talking about the fundamental analysis. And what are you looking at? You're looking at the financial statement. Okay, before you look at the financial statement, you're looking at the company itself, right? Looking at the management of the company. The management of the company, are they people that are of repute? Why are you doing that? You want to be sure that the company is properly run. Then once you look at the management and say, okay, this management, they are doing what it is they are doing. So you look at the board, then look at the management, same difference. I just put all of them together, the board of directors and the managers. So if somebody in the board of directors is a thief, a known thief, you know that this company is not a serious company. They won't bother wasting your time there. It's the truth. Or the person has done Ponzi, you know that this person made his money through Ponzi, and that person is in the board of directors of that company. Very soon, the Ponzi people's investment just run. Okay, this is me just joking a bit. So if the management is solid, then next you want to do, you want to look at the financials. And when looking at financials, there are three statements you're looking at. In simple terms, you're looking at the income statement, you're looking at the balance sheet, and you're looking at the cash flow. So what is the income statement? The income statement simply tells you how profitable the company is. A company can be profitable and the company will still go bankrupt. A company can be profitable and the company will still go bankrupt. So if you check that the company is profitable, you also want to go and check at the cash flow statement to ensure that this company has a positive cash flow. The reason why is because just as blood is the life of a human being, cash flow is the blood or the life of a company. So even if so, profitability simply means that this company has made a sale and this company is profitable in quotes. Cash flow simply means that that sale that this company made, that cash is with us currently. Because some businesses they do businesses and they get paid say 30 days later, 60 days later, 90 days later. Do you understand where I'm coming from? So a company can be profitable and you don't invest in that company simply because you check the income statement, there's profitability, and you now check the cash flow statement, there is negative cash flow. It's only a matter of time because the company needs cash to operate. There's something we call working capital. It needs that to be able to function. And how do you know if the company is doing well? You check the income statement, then you go to the cash flow statement and you check if it's okay. Fine. Then the next thing you also want to check is the balance sheet. For for some reason, some people say that a company that is in debt is not a good company, but that's not true. Some sectors are highly leveraged sectors. So a typical example of a sector that is highly leveraged is the oil and gas, is the power sector. So a company can be in serious debt so long as they are managing their debt. It is fine. You can still invest in such companies. So I'm telling you exactly how it is. Another person will tell that if the company is in debt, don't invest in the company. So what is debt? Debt plus equity is equal to capital for the business, or is equal to asset. Asset is equal to debt plus asset is equal to debt plus equity. That is the asset of a company. I know I'm digressing a bit. I'm trying to explain it granularly so that you understand what it is you are looking out for. So now you have checked the management, fine. You have checked the financial statements, fine. So that is the fundamental analysis. Then when it comes to technical analysis, you want to check the price. Technical analysis has to do with price movement. What did you trade yesterday, last month, last year, 5 years? Then with that, you should be able to, it's quite broad. You use what we call indicators to be able to predict where the price is going to go to. So based on that, right, you have done your, those are the analysis you have done, the fundamental analysis and the technical analysis. For some persons, fundamental analysis is enough. For some persons, technical analysis is enough. But a good analysis, if you're doing a good analysis, technical analysis will confirm what fundamental analysis has already done. Or fundamental analysis will also confirm what technical analysis is saying. There's another kind of analysis, which is sentimental analysis. Sentimental analysis that Mukki is buying Dangote refinery, so Joseph is buying Dangote refinery. That's sentimental analysis. Joseph did not do anything. Joseph only heard that Mukhtar is buying, so he's now also buying. That kind of analysis is also there, but we don't talk about it because that one will lead you astray. Anthony, I hope I answered your question.
Yes, yes, very clearly, sir. Thank you.
You're welcome.
Yeah, thank you for your question.
Joseph, we
TJ,
should close. Oh,
yes,
Please, sorry,
yes,
I
yes.
just have a follow-up question. Sorry, on what Anthony asked. Sorry for hijacking. Can I
Yeah,
quickly?
go ahead.
you have
You
already
hijacked.
hijacked.
Go
Go
ahead.
ahead now.
Sorry.
Yes.
So this analysis and these questions that you told us to research on, is this something that is publicly available for us to get? These
Uh,
Very publicly available.
Okay,
Very
okay,
publicly available. Every listed company is a public company. And
all right.
because they are public companies, their financial accounts are public. And if they don't publish their financial account as at when due, they will be fined. And in Nigeria, the fine is not small money, oh, even if it can be small money for some persons. So they are fined 100,000 naira per day for non-compliance if you don't release the account in time. So you see, a company would be having, say, 100 times 10. So in 10 days, would have incurred 1 million naira. In 30 days, it's 3 million naira. My math is correct. Yes, I think my math is correct. So in a month, we would have incurred about 3 million naira. It is not working day, it is literal day. They are penalizing 100,000 naira per day. And it gets to a point, if they don't want to bring they still don't want to bring the account, they will be delisted. There's a whole process of delisting that happens and all that. Yeah. So this information is very important and it is publicly available. You can have those information on the company's websites or on the stock exchange website. You can get those accounts.
yeah. Thank you very much, Mukki. If you're unsure of how to navigate the company's account or even stock exchange account portal, just a simple Google search. Let's say you're interested in MTN, you just type, MTN's financial statement 2026, 2025, or 2024. You will see Google will bring out options, and you just click. It takes you to either the stock exchange's portal or the company's portal where you will see all the annual reports and download the year you're interested in. Yeah, so it's one thing to have access to those things, and it's another thing to understand them, and it's another thing to use the understanding to make money or to invest. So, but I mean, the first part is actually getting access to those documents, and I think you can do that very easily. Thank you very much. The other thing to mention is nearly all the insightful questions that have been asked tonight, nearly all of them are can function as standalone topics. You know, even the question about how to invest in the stock market, the question about if the business should invest, the questions about all the questions are standalone topics, and we've had some of them in the past, and we're going to have some of them in the future. So depending on the questions, we have the YouTube channel where I think even Mukki has had one of these sessions with us. Questions about how to invest as well, fundamental analysis. We have a document in Chika. Correct me if I'm wrong. I think that's not a session. That's in the blog, right? Um,
Yeah,
Sorry,
that was an article
what
yeah,
did you
there's an
ask?
article.
on
Okay, don't
fundamental
worry. Yeah,
analysis.
Well, I'll drop the link
yeah.
now. I'll drop it.
Okay, okay. So, and tomorrow as well, we have another session, which I believe would answer some of the questions that are asking me in the comment box. I have one question, but I'll leave it tomorrow for Chimex. It has more to do about risk and return. Um, so I think we're now 22 minutes past the time. I just want to thank everybody for finding the time to join today's webinar. It means a lot, even though it's entirely free. But the fact that we have someone like Mukki that has a lot of value to give and is sacrificing his own time, and we have people taking up that opportunity, it means a lot. So thank you very much for finding time to join. And hope is we all get to a position where we're making money seamlessly with the knowledge that we have in a very um, secure and viable way. And to Moki, thank you. We can't thank you enough. You're a top value to our community. Thank you very much for continuing to do what you do best. And I mean, we have multiple sessions. Apart from tomorrow's, we have another one in April, May, June, July, just like that till I think November, December this year. So if you have time, just keep an eye on all the webinars that are coming your way. And if you're in the S&P finance WhatsApp group, you will have all this information as well to know where and when we're having the subsequent sessions. I don't know if I'm missing out on anything. So Muki, there are a few questions here, but because of time, maybe we'll take them to the group chat. Um,
Yes, please. I was going to say
I'll
that
want
we
to
should take them to
assume,
the group chat.
yeah. So I'd want to
The
assume
the
that
the
those
link
that have
the
asked,
link isn't responding. That is the challenge. The link to the group chat isn't responding.
I
It
think it
is now.
is. I can see a few people that have joined. Can you try again? Or Chika, can you reshare the link?
I can't copy the link.
So
Once you click it, it's not responding. So I don't even know how to access it.
let me paste it again for you.
After
Um,
clicking on the link, you see a redirect link. Click on that redirect link and it will take you straight to the group.
I should click where?
After clicking on this link, you see a redirect link. Click on it and then take it straight to the group.
uh, it's fine. Tochiko, let me send you. I can't send a private message here. Otherwise, I would. Let me just send you my number. Anyway, it's public. I'm not
Have you been
exactly
able
there.
to
So,
join?
No,
so if
no.
you're unable to join, just send me a message via WhatsApp, and I would add you, or you can send your number here. Either way, let me send mine because of data privacy. So this is mine. So you just
Okay, okay. I've seen a
yeah,
number.
just send me a WhatsApp message. Yeah, and I'll add you to the group. Then all the
Okay,
questions, please, if you've asked any question here and you're very interested in the question you want an answer, you would have to get it in the group because of time. Because I'll move all the questions to the WhatsApp group now. So thank you all very, 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 very much for your time, and we look forward to having you tomorrow. Same time, same place, same link, right, Chika?
yeah. Thank you, thank you.
Yes, yes. Same link tomorrow.
Yeah. Okay. And thank you all.
Thank you,
And Muki,
everyone.
thank you, and God bless you.
My
Yeah.
pleasure. Bye. Amen.
Happy Global Money Week to everybody.
Happy Global Morning Week.
Happy Global Month. Thanks.